Good morning, everybody, and welcome to our webinar today. My name is Angela Brown, and I am a financial advisor at Compass Private Wealth. So as some of you are aware, we are running a series of webinars throughout 2021. In January, we reviewed investment markets. In February, we looked at retirement funding. And today, we're reviewing protection for me and my family. In April, we plan to focus on succession planning, and our webinar is scheduled for the 15th of April. We'll be sending out invitations in due course. So as always, I'll just run through some housekeeping. So questions can be submitted throughout the webinar by clicking on the questions icon at the bottom of the screen. The webinar itself is recorded and slides will be made available for anyone once the webinar is over. We will also be sending out a short online feedback form, and we'd really appreciate your honesty. Today's webinar on protection will be presented by myself, Angela Brown, a financial advisor at Compass Private Wealth, and also Jonathan Sheehan, Managing Director of Compass Private Wealth. So without further ado, I'll pass you over to Jonathan.
Thank you very much, Angela, and thank you to all of you for registering this morning. We hope to have this completed by 10:30, but maybe 10:35, because we have a lot to get through. So firstly, I'm going to speak a bit about financial risk management at a very high level. So starting off, in your life, there's three main risks. There's up until this point, so reducing the risk of your financial assets that you've built up to this point. There's also, mitigating the risk of your future earnings. So whatever your current income is, what your earnings are going to be in the future, to protect that. And also for anybody with children or grandchildren, to make sure that, I suppose, your family and your intergenerational assets don't get depleted due to illness or death or unavoidable taxes. This is a crude chart, but it does show, I suppose, the four different types of ultimately families or individuals. And I suppose the higher up the chart you are, the more protection you need in a lot of ways, because it's very easy to fall down a notch or even down a couple of notches, either through a market downturn or through somebody getting sick and losing their earning potential. So it really is about, from a financial planning point of view, trying to get up to the higher levels on the scale. And then once you're up there, the only real way of protecting your position is by ultimately financially protecting yourself through either life policies, protection policies, tax planning, and general wealth preservation strategies. So what are people's financial priorities in life? So before we even talk to somebody like myself or Angela, you need to enjoy your money. You need to not worry about it, and also have financial freedom. That's the most important thing, okay? So don't let any negativity out there have any implications from a negative point of view. Financial priorities, enjoy what you have. But in order to enjoy it, you need to also reduce the risk, okay? So there's nobody on the road today, I'm on Bagot Street today, there's no cars driving past who don't have car insurance. There's no houses or commercial premises around, or businesses that don't have commercial insurance, of property insurance, or whatever it might be, public liability insurance. So it's amazing how little insurance we have for ourselves, based on, say, our income, for example. And I think the reason for that is simple. It's because, people don't force us to have income protection insurance, whereas they do force people to have car insurance. So I suppose the purpose of this is to educate you on what the options are, and for you guys to talk to us with any further questions you have. So protecting you and your dependents. The three main risks really are you or your family are left financially destitute, you're no longer able to work, and your future lifestyle does not come to pass due to reduced earnings because of death or illness. Now, we have a lot of content in today's presentation, so we will be sending all these slides afterwards, so it'll give you more time to go through the detail of them. So who doesn't need financial protection? It's just as important a question as saying who does. So somebody who's retired, so anybody on the call today who's actually retired, who has sufficient wealth built up and pension income coming in, does not actually have an insurable interest as such. So the downside is that they've already built up their assets. There's no real future earned or employment income to protect against, and they have no debt, and they have generally their children, if they have them, are financially dependent at that stage because they're adults and they're earning themselves. Or a younger individual who doesn't have financial dependence, or a spouse who's financially dependent on them and doesn't have loans or whatever it is. So their need for insurance is less than other people. Now, they might still need income protection, whatever it is, but generally they're the two extremes of the cohorts of people who need less protection than others. Who does need protection? Somebody who has a good employment income or self-employed income, and who has either a spouse or children below the age of 18 or 23, whatever it might be, who are financially dependent on them. So generally somebody below the age of 50 has at least 15 years of future cash flow surplus or future income ahead of them that we factor into their financial planning models that needs to be insured against. And it's not just for their well-being, it's also to pay back the bank. It's also to support their children in terms of, like, the child benefit is 140 euros, whatever it is per child, which is obviously nothing like what's needed for educational costs and just general costs. And also if a spouse isn't working, then there's more of an onus on an individual to have financial protection. And also a self-employed business owner who has financial dependence, who has no company debt and service. So business owners on the call here, there's more at stake for them because their assets are greater, yet there's nobody forcing you to take out life insurance. Maybe a bank will if you take out a loan, but other than that, there's nobody forcing you to, so it's incumbent on you to set that up yourself. So now I'll pass over to Angela, our protection expert, to talk about the different types of protection cover.
Thank you, Jonathan. So as Jonathan mentioned, I'm going to discuss the various types of protection cover available. There are three main types of protection policies. There's life assurance payable on death. This is usually one lump sum payment, which is paid on the debt of the life assured. This can come as a term cover. It can come as a whole of life cover. There's also specified illness cover. Again, this is usually one payment, one lump sum payment in the event of the life assured being diagnosed with a specified illness. Our third protection cover is income protection. Income protection is a policy basically designed to pay out a regular payment in the event that your income ceases and in the event due to you being unable to work. So our first type of cover that I look at is term cover. As we mentioned there, term cover it's a fixed term, and it's usually associated as well. There's a fixed premium. This can come in a term policy or a mortgage protection policy. Both policies can be assigned to a lender or a financial institution. The main differences, again, between these two policies is a level term policy. The sum assured remains the same throughout the policy. So with a level term policy, the sum assured, the term and the premium all remain the same throughout the policy. However, with a mortgage protection policy, the premium and the term remain the same. However, the sum assured actually reduces over the term of this policy. Both policies have the option to include a medical-free conversion. This is basically where you can extend your cover beyond the expiry date without having to submit any further medical information. So if I took out a 20-year term policy, and at the end of the 20 years, I wish to extend this policy, it will be reviewed on the medical information which I submitted 20 years previously. This is usually about a 10% additional cost to the existing premium. Term cover can be taken out on a single life, a joint life, or on a dual life basis. Single life basis is one person takes out the policy and there's one person assured. A joint life basis is where two people take out the policy and then the sum assured or is payable on the death of the first life or the death of the second life. This will be decided when the policy is actually being set up or taken out. A dual life policy then, again, is where this policy is taken out by two people, but both people are insured separately. So there's two people, there's two life assureds, there's two sum assureds, and there's also the potential for two separate payouts in the event of death. Companies can also take out an umbrella policy for staff within a group structure. Medical underwriting is limited, however, it is required when the policy exceeds a certain limit. The main differences, so we'll just compare both our level term cover and our mortgage protection cover. Again, both have very, very similar features. When applying for at the application stage, you both submit the application form, they're both reviewed by underwriting, the medical information is required for both policies. Your term is covered, your term is set out when applying. The lump sum is predetermined, the monthly premium is the same for both policies. Both policies, a level term and a mortgage protection term, can be assigned to a lending institution. However, the key differences between these two policies is that the level term policy, the sum assured, will remain the same throughout the whole entire term of the policy. With a mortgage protection policy, the sum assured reduces each year. The medical free conversion option is available for both policies. However, it was not very common within a mortgage protection policy. It wouldn't be a common feature. The mortgage protection policy is also usually taken out on a joint life, first death basis, The sum assured on the mortgage, as the sum assured reduces within a mortgage protection policy, this usually comes down with a lower premium. However, the level term premium is slightly more expensive, but it's usually better value as the sum assured will remain the same. So the main reason for that would be 10 years into a policy on a mortgage protection policy. If you took it out for 100,000, this will have reduced and it could be down to maybe 60 or 70,000. Where your level term assurance, this will remain the same at 100,000 for the whole term of the policy. So for that slightly more expensive premium each month, it is a better value policy. So income protection. Income protection is a policy basically taking out to replace your income in the event you're unable to work due to illness or injury. It's paid each month by the insurance company, and it's to replace your loss of earnings. It'll remain in place until you're actually fit to return to work or until the policy actually expires. When you're taking out an income protection policy, you can't insure your whole salary. You can only insure up to a maximum of 75% of your salary minus social welfare. This is basically designed and it's in place because it's in place by the insurance companies just to review, so you can actually review it's in place just so you can't insure your full premium or you can't insure your full salary. This is really just a way for the insurance company to emphasize and that you're not being rewarded for being out of work. Income protection basically gives you the peace of mind of knowing that in the event of you being unable to work, your bills and your regular income replacing that. When taking out an income protection policy, some features that we need to remember is the benefit amount. That's basically the sum assured. That'll be predetermined at application stage. And again, you can only cover up to a maximum of 75% of your salary, less social welfare. You'll also be looking at the deferred period. This is the time basically between claim stage, in the event of a claim where you're actually unable to work and the claim will kick in. This deferred period can range from anywhere from 4 weeks to 13 weeks, 26 weeks, 52 weeks. We'll also review the term of the policy. So that's basically how long you want this policy to be in effect for. It can expire at age 60, 65, 67. Just tax on the premiums. So for an individual taking out an income protection policy, tax relief is available at up to 40%. For employees, there's no benefit in kind on company-sponsored income protection. And for employers, this is a tax-deductible expense. So the main reason, again, that you would actually take out an income protection policy is just to give yourself the secure and peace of mind of knowing that your income is protected in the event you're unable to work. So everybody here can ask themselves today, if my income ceased today, have I sufficient cash or have I sufficient savings to meet my everyday expenses? Now, everybody here also has different everyday expenses, whether it's a mortgage, rent, utility bills, food, children's education, cars. So if you answered yes, that you have sufficient savings, another question to say is, how long will my savings cover my expenses, and how long will I run out for if I was unable to work due to illness or injury? Again, if this is a question, if you raise concerns as to how long you would like your savings to be eating into these expenses, you do need to ask yourself, do I need income protection, or is this an option for me that I'd like to consider? If this is an option, feel free just to reach out or email the Compass office or the Compass mailbox. Serious illness cover. Unlike income protection, serious illness cover is a lump sum payment, which is paid out in one lump sum, and usually it's paid out in one lump sum. Serious illness cover is usually taken out initially and it's in conjunction with any term assurance policy. The serious illness cover can be taken out in two ways, as one accelerated serious illness or as a standalone serious illness policy. How this works is the difference between the two is basically, if I was to take out a serious illness policy, a standalone serious illness policy, if I took one out for €500 lumps, a €500 sum assured life protection policy, and a 100,000 serious illness policy in the event of a claim. So basically, the total sum assured on a standalone serious illness policy would be 600,000. So if in the event of a claim where I fell ill and my claim was successful and my serious illness claim was paid out, 100,000 of the serious illness cover is paid, and the €500 or 500,000 sum assured life cover, death only, will remain in place. However, an accelerated serious illness policy, if I was to take one out for 500,000, and of the 500,000 sum assured, 100,000 is accelerated serious illness. How this would work is, in the event of a claim, or in the event I was diagnosed with one of the predetermined serious illness, in the event of a successful claim, 100,000 will be paid out. This 100,000 is reduced from my total 500,000 life cover. So the 100,000 is paid out, and that's paid as a separate serious illness claim. However, the remaining 400,000 remains in place for a debt only cover, and this will be paid out then in the event of death throughout the term of the policy. The main differences between serious illness and income protection are, so for serious illness, the policy is paid out as a single lump sum payment. This is only paid out once in one lump sum. A claim must meet the predefined serious illness requirements that are set out at the inception of the policy. Once the claim is paid, the serious illness policy is cancelled and no further claims can be made, and there's no tax relief available on the premium for a serious illness policy. However, with an income protection policy, this policy will be paid pre-decided benefit in the event that you're unable to work due to illness or claim. The benefit is paid on a monthly basis, so it's not one lump sum. The benefit is paid every month until you're actually fit and ready to return to work. This benefit, the income can be insured to a maximum of 75%. It is also available to make multiple claims on an income protection policy. So if I was unable to work this year due to some illness and I was off work for 6-7 months, and then I returned to work, and in 2 years down the road, I fell ill again, I can actually resubmit a whole new claim and start the process again, and the claim will be paid throughout the term until I'm fit to return to work again. There's also tax relief up to 40% available on the premiums for a serious illness policy. So thank you. I'll pass you back to Jonathan now to continue.
Thank you very much, Angela. That was very insightful. So just to summarize there, the three different types of policies, it really depends on your own certain circumstances. The classic case for somebody who needs income protection is somebody whose income is very much geared towards their ability to ultimately use their brain power, their intellectual capital. So I mean, solicitors are classic case of they might have very high fee income, or barristers or whatever it is, accountants, and all of their wealth, I suppose, or their future earnings dependent on them working. Somebody who's got a lot of passive income already, like property, rental income and stuff, income protection wouldn't be as relevant for them, because there would still be an income stream coming in if they were ill, because that's not going to affect your rental income. A good risk, by the way, is that you live long. That's what I'm going to speak about here. So people talk about pensions, and a lot of people just shove money into a pension and they say, well, I just want to build up a fund of X. They don't really know what the purpose is. So we all want to retire young and live long, but ultimately in retirement, earnings will cease or reduce. The cost of living is going to go up with inflation, and the state pension isn't sufficient. So in the context of this webinar, what you want to do is you want to protect against your future earning for as long as you plan to work. So if you plan to work, if you're 55, you want to work till 65, you want to cover off that income for 10 years, but you also want to cover off your retirement from 65 to potentially 90 or 95 or whatever it is. So that is a risk in itself. It's a good risk. We want to live until we're 100, but we also want to enjoy our retirement. And ultimately building up a pension fund is mitigating the risk of running out of money, if that makes sense. In our last retirement planning webinar in January, we went through this slide. It's a nice infographic to show how we're living so much longer, and we have longer proportion of our lives are ultimately going to be in retirement. 20 to 25 years of extra spending in retirement with no earned income, and the cost of living increase in retirement in a lot of cases, and ultimately the state pension isn't enough. So depending on what your age you are, you need to make sure that the existing assets you've accumulated are covered and insured. Your future earning potential, and when I say earning, I mean employment income, earned income, self-employed income, not passive investment income, that's insured to an extent, and also that your retirement years are insured. One way of ensuring it is working longer, but most people would rather invest in a pension and retire a couple of years earlier. So keys to retirement planning: complete a cash flow analysis, ring-fence fund surplus to your needs, and make long-term tax-efficient financial decisions, both for pensions and protection. Long-term tax efficiency, and be proactive. So if someone wants to retire at 60, they are looking at 30 years of no more earned income, higher costs in retirement. A lot of people say, well, I want to protect my retirement. How much of a lump sum do I want to build up? And remember now, anybody on this call here who's of a certain generation always was brought up based on defined benefit pensions. The public service and civil service still have that, but most private companies no longer have a defined benefit. So rather than them saying to you, okay, you retire at 65, you get X amount per annum, now it's incumbent on us to protect our own retirement by funding our own pension on a kind of proactive basis. The rule of thumb I have is multiply your gross income need by 20 to capitalize it. So if you want 120 grand a year gross income, you need a 2.4 million pension pot. I mentioned in the agenda, in the invitation, that we're going to speak very briefly about protection for entities. Entities, what I mean is either companies or partnerships. It's cheaper for an individual to group themselves with a lot of other individuals to take out a group insurance policy. And the main reason for that is because it's frankly cheaper for us. It's less work for us, and it's less work for Aviva or New Ireland or London or whoever it is, whoever we choose to place the business with. It's also cheaper for them when it's one big block policy as opposed to 50 different individual policies. So you get more value for money. So group protection, companies can set this up for a lump sum benefit for an employee dying, which is usually a multiple of their base salary, and also a monthly payment for income protection. And for a lot of employers, it's very, very cheap to put this in place. So like if an employer has 100 staff, it's a hell of a lot lower cost than if 100 people were to take out group cover, individual cover. It also gives the company or the partnership peace of mind knowing that their everybody's going to be looked after in the event of one of the employees falling ill or dying. The price depends on the benefit amount. So if it's 4 times salary, for example, what the deferred period is for income protection, so how long they have to be out of work for. Remember, a lot of companies have a sick pay policy where they might pay for 3 months. What happens after 3 months? Do they there bring the deferred period for income protection to come in after 3 months? And the term of the policy. So usually that's just what they call the NRA, the normal retirement age, which correlates with the company pension scheme. Tax and premiums, as Angela said earlier, for employees, there's no BIK on what the company pay, and it's tax deductible expense for the company. I'll send these slides out, obviously, but for any professional advisors here, like tax advisors or accountants, it's really clever for SME businesses, or for any clients here who are actually in, 3 or 4 shareholders or partners in a company to insure each other. So in this case, a shareholder dies, they have 25% equity in the partnership of the company. Who buys out their company, their shareholding? And on the next slide here, income protection for entities. What happens if there is 3 equal partners in a partnership, and one of the partners falls ill and is no longer able to work and earn? Then their share of the partnership, their income is going to fall away. So by far, the best practice is for those 3 partners to set up 3 identical income protection policies together. Now, what we do is we advise 3 types of clients. We advise an individual. If you're self-employed, or if there's an accountant here who's advising an individual and it's just them in the business, then they have no choice but to set up an individual policy. It's probably more tax efficient to set up through the company. Then you look at an SME or mid-sized firm, anything from maybe 2 or 3 shareholders to 10, and then above that you get into kind of the corporate type of protection. So that's our presentation. We've nailed it on the timing. We're 2 minutes to go till 10:30. So what I'm going to do is I'm going to stop sharing. Angela's going to come back in here, and we'll just have a little chat ourselves between myself and Angela. I'll come back in here as well, and we have one question here which I'll field. The first question is there tax payable on the income protection benefits? The answer is yes. So revenue will never give you tax relief for a premium and not tax you on the benefit. But generally speaking, if you take out income protection, and there's obviously Compass don't advise on tax, and there's get your own tax advisor, speak to your own accountant, but the band for the 20% standard rate is 35, just over 35,000, say. So a lot of people would be earning, who take out income protection, are earning above that, so they get tax free for 40% on the premiums. And then if they say take out a benefit of 45,000 per annum, the vast majority of that benefit then is taxed at the 20% rate. And it's only the next 10,000 is taxed at the 40% rate. So it's tax efficient in that you get full tax relief on the premium and you get lower tax payable usually on the benefit. Angela, just a question for you is like, what would you recommend generally for between serious illness cover and income protection, or would it be a bit of both?
Ideally, in an ideal world, I'd recommend a mix of each. So a lot of people would already have some sort of lump sum cover in place, whether it be via their mortgage protection or their debt and service through work. And then ideally you'd review financial needs, and you'd be looking at, and you'd try to get a nice blend or a mix of both a lump sum payment and income protection. The main, I suppose, with the lump sum or the serious illness cover, this is only paid out in one lump sum. And again, if you're taking out a new policy, you must meet these predefined conditions before that lump sum payment is actually paid. So with income protection, it's paid out on a monthly basis, and it's to replace your income. So I suppose if you have a blend where if you have like up to maybe even 60% of your income, if your income covered, and maybe a small reduce that serious illness cover. So rather than take out the full 100,000, maybe 50,000 of a serious illness lump sum. So again, just to, I suppose, it's designed in the name there, serious illness. This lump sum isn't paid until you are at, like, it's a critical illness or a serious illness payment. So there is these predefined conditions that you must meet, or at least with the income protection, it's paid regularly and it's to replace your income. So I think to have, my first recommendation would always be to have a blend of the 3 different types of protections.
Yeah, and I think what's important as well, and just kind of feeding another question indirectly that's come in, is that it's about underwriting. So obviously an insurance company will underwrite you to medical and fill out a health questionnaire. So if somebody, say with income protection, has a bad back, the insurance company will actually charge you the same premium, but they will exclude back injury.
Yeah.
Whereas if you go for life cover or serious illness cover and you've had a heart attack the year before, they will most likely completely refuse your cover, or they will load you significantly where they say, okay, we'll insure you, but it's going to be 3 times the normal amount. Now, one way of getting around this, okay, is through group risk. Okay, we talked about non-medical limits. So anybody here who works for or has worked for a big company, they usually they usually would have a 4 times salary death in service default sum assured built into the contract. So often for smaller companies, if there's somebody, a shareholder, who has their own health condition, they can actually club together and set up a group risk policy, and they'll be maxed out what the medical limit is, the non-medical limit is. So it's one way of getting around having underlying health conditions, being afraid of being refused cover personally. The other thing as well to be conscious of is that a lot of group policies have what they call a continuation option, so that if you ever leave or have left, you can take your cover with you without having to undergo medical. So look, I'm conscious of the time. Thanks for the questions. There's a couple more we haven't got around to, but I wanted to keep this short and sharp. We'll send out the slides later this morning. We are running another, it's not a webinar, it's a brief presentation tomorrow on a regulation. It's a snap presentation we've decided to do in light of everything that's happening with Davies over the last week or so. So we'll send out details of that. It's only going to be very short like this. It'll be more of a presentation format to talk about avoiding conflicts of interest, custody of assets, all that type of thing. So we'll send that out as well. Maybe, Angela, we'll send that out as part of the follow-up today. Thanks to all of you for joining, and have a nice day, and we'll speak to you soon.
Thank you.